Cool, guys. I think let's kick off. It's 9:02, and we got quite a bit to get through. So, Graham, on that point, because it's Black Friday's looming, we thought we'll talk to you guys a little bit about saving and investing today. Just before you start writing those checks for the new flat screen TVs, that we make sure your mind's in the right place. But it's great to have all of you. And can you believe it? It's our last coffee session of 2024. So here's another scary thought. In a little over a month, we will tick off the first 25 years of the new millennium. I don't know about you, but it feels like just yesterday we were all worried about the Y2K bug and the possible end of the world. And here we are 25 years later, and we thought it is appropriate moment to talk a little bit about time and about money. You know, as financial advisors, we need to create financial freedom. I think firstly for ourselves, and then secondly for our clients. So today we're going to discuss a topic that I think will benefit you and also your clients in a substantial way. Talk about the compounding power of long-term investing to create financial freedom. We'll talk about what financial freedom looks like, how much is enough to retire on, and a few other things. As always, Ian will lead us in with a brief overview of the market and the world around us. And then I will jump on to taking control of your finances and creating financial freedom. As always, guys, you're welcome to ask a question at any time. You're welcome to post a question in the chat box. Otherwise, we're hoping there will be a bit of time left for questions at the end. Ian, on that note, I'm going to hand over to you to talk to us a little bit about what's happening in the world around us.
Cool, Eddie. Thank you, man. Yeah, great, guys. Good to be with you again. I thought we'd start with this quote, and it's in line with the theme that we've got, which is the long term. I know we always talk about the long term, but as Eddie said, it's phenomenal that at the end of this year, we had 25 years into this century. So Morgan Housel, and you'll hear a little bit about him. We've got a few more quotes, but he had this interesting quote. If you want to do better as an investor, the single most powerful thing you can do is increase your time horizon. Time is the most powerful force in investing. Make little things grow big and big mistakes fade away. Psychology of Money. If you guys haven't read it, it's really worth getting that book, guys. Really a great book to read, and he's a phenomenal writer, phenomenal educator. So yeah, definitely worth your while. I would highly recommend it. So let's just look back. This is to the end of October, and it's been a really, really good year all round. And we've obviously highlighted 2024 there. These are all in dollars. I just like to put common currency. So these are the market returns of various, mostly risk assets. So we've got the all country at 16% in dollars. I think we're up at about 19%, and we'll talk a little bit about that. I mean, this month has been phenomenal for risk, mostly US markets. S&P 20%, we're up at 25% now. So it's been a phenomenal year, following on from last year's 25%. And then as we go through, obviously we saw China, the CSI 300. That struggled over many years, but it had a bounce. We've discussed that a few months back. So it had a bounce up, struggled a little bit more, but still doing positively. I think importantly, the JSE has had a very good year. So up until the end of October, it was a whole lot better than where we stand now. So 18% in dollar terms. A little bit of that, a component of that was currency gain, which we've given up a little bit now in November. So that's come off a little bit. And then you've got other risk assets. I mean, I put there Bitcoin. That's the classic risk on asset. You see phenomenal ups and phenomenal downs. Up 66%. That's obviously post the Trump had a big jump up again in November. And so it goes. So really, I think all round risk assets have done well, and everything else hasn't really done exceptionally well. You can see there the currency as well is a factor. We were a lot more positive. That's 3.9% the rand versus the dollar, but it's a little bit of shine has taken off, but still not bad in the scheme of things, given the depreciation in the previous years, as you can see there. 8, 7, 7.5, 5. So it's a nice little pullback this year, which is really great. So just a quick slide on this. Obviously, a lot's happened. This is sort of obviously into November now. This sort of Trump, which is obviously the Republican Party's coming in, sweeping through into the White House, and obviously with the Senate and the House, it's been quite a shift, obviously, from the Democratic Party. He's obviously coming in, and that party's coming in on a few things, and the market took it as positive. I think a big thing is obviously corporate and individual tax cuts. Um, in general, I do believe that's a positive thing. We've seen that in the past. You reduce taxes, you actually stimulate the economy. And we've seen that when he came in the 2016, 2018. When was it? 2018. Yeah, oh sure, seems such a long time back. Some of those tax cuts, I believe, that he implemented expire next year, 25, and obviously those were from the initial run. So that's there's going to be more extension of that. Another one is tariffs and protectionism. I mean, yeah, the question mark is, does that lead to higher inflation? There's a degree to which that is the case, but you know, these things are never straightforward. In many cases, tariffs are used as a negotiating tool. The reality is that it's been a US dominated market into November. Strong dollar, strong US performance, and pretty much weakness across most other assets around the world. Obviously, South Africa, as I said there, we've taken a little bit more of a hit. It's still not too bad. Currency is a little bit back off. But yeah, strong dollar. And so the market in general globally has taken this as a positive thing. So we'll see what happens. But if we wind back and just look, like, again, over the last 25 years, and I've highlighted this now, 25 years, and this is very interesting. This is in dollar terms. The S&P has made, call it 8%, over this first portion of the century. It's been a phenomenal run over the last 5 and 10 years, 15 and 13% in dollar terms. And we know that some, like the JSE, hasn't been great. 10 years, it's been pretty dismal at 4% in dollars. A little bit better over the last 3 years. But it is interesting to see that it has actually outperformed on a like-for-like basis at 9.5%. And I've just juxtaposed that with this quote from Voltaire going way back. He just spoke about money going down to its intrinsic value. And I think we just have to keep that in mind all the way through. AD is going to take you through some of that thinking. It's just to constantly, I think we have to reinforce into our minds and our clients' minds that we have to be taking a degree of risk. And risk ultimately does pay off. But just again, extending this last 25 years, and this is a chart, if you look there from 2000, an upward slope, and that the first 10 years was when emerging markets were outperforming, and then the downward slope. In the last 15 years, where we've actually had pretty much a strong underperformance of emerging markets, but against the US. So the first 10 years, the US underperformed, and the last 15 years, a big outperformance. A lot has happened, and there's a lot of reasons and rationale when we look back over this time, but I think it is useful. I think a couple of key points here, and I've listed a whole lot of milestones that we've actually had over the last 25 years. But I think a big factor at the start of the century was the fact that we had expensive valuations for the US, and that led to underperformance all the way through for the US, right up into the financial crisis, 2008, 2009. Conversely, an emerging market like South Africa, as a prime example, was very undervalued post the Asian crisis. And so, in fact, it had a very good 10 years, mostly up until about 2007. And then we also had a bit of an unwind in the 2008-9 crash. But it actually performed very nicely. And that strong outperformance produced an outperformance over 25 years. So if you just had if you sat and were patient enough over 25 years, you've actually outperformed sitting in South Africa. But clearly, if you could actually get the, have the benefit of underweighting expensive markets and overweighting undervalued markets, you'd be better off. So the question is, on to the next slide, do we find ourselves in the same scenario now potentially as 25 years ago, when actually on a lot of metrics, and this is the big question mark and something which we're constantly trying to ascertain, and is that has the US again now got to very, very, very expensive levels? On so many metrics it has. I've just put these charts up. We don't want to go through them in detail, but it's just a lot of different charts as to how expensive the US is. If we look at the equity risk premium, which is measuring the earnings yield versus bonds, if we look at price to book, price to sales, and then other metrics as well, like, which is where there's high degree of appetite for risk, and that's in credit, especially high yield and investment grade, where people are paying very high prices. So valuations have come down quite a lot. So this is the big thing. Is it expensive? Yes, it is expensive. Can expensive continue? And that comes to the next chart, which some people, and this is coming from an economist, Ed Giardini, a very well respected economist with a lot of information, a lot of history. He's been on the money for such a long period of time, and he's one of the most, if not the most, positive people still on the US. And his forecast is that the S&P, which has just come through the 6,000 level, is going to get to the 10,000 level in 6 years' time, 2030. If you do the maths, it seems like a big stretch, and that looks like a phenomenal chart, overreaching, but it's not impossible, given that you compound up 6,000 where we stand now at 10% a year. And if we see that what the US has done, it's not impossible. But as we know, things don't go in a straight line, so it'll be interesting to look back, next 4 years, next 5 years, next 6 years, and just get to see what's actually happened. So anyway, that's what makes markets. You've got a lot of negative people saying things are way too expensive, but then you do have a lot of positive momentum, and we've seen that positive momentum come in. One of the things that you can't ignore is, and we haven't really looked at this in the past, but or showcased this, but this is something which we do look at or try and understand a little bit, and that is the money supply growth. And this is a rate of change. So it might be a complicated chart, but if you look there, it's the annual rate of change of broad money supply, M2 growth. And in general, it can grow between 5, 6, 7% a year. I've highlighted this, last call it 7 years or so, because this was obviously a huge spike up, and that spike up in the money supply was the COVID spike, and that's when obviously the US put a lot of money into the system, and a lot of that money came from the government, where they actually, literally sent checks to everyone. Huge amount of money supply growth. M2 is essentially broad money supply, so it's currency, check accounts, savings, money markets. So obviously, to stimulate the economy, the growth went crazy through the 25% level, 25% per annum level, way up from its sort of 5, 6, 7% level. That obviously led to a high amount of inflation, and obviously that had to be crimped back. So the rate of change obviously came down. You have a base effect, and now you can see in the last bit of time it went right down to below negative. Rate of change now is positive again. In general, that the whole economy, world economy, is based on money supply growing. It's comes back in a way to what Voltaire said. If money supply is going to keep on growing and you're not getting compensated for it, obviously the intrinsic value of that is just going down to zero, which is why we need to be taking risk and putting our savings and investments into a high percentage of risk assets. So it's an interesting chart to follow. What that led to, and this is a chart, a long-term chart, and we've discussed this a bit. There's obviously it's a hugely topical area, hugely concern area. The U.S. government debt levels. Is it a looming problem? Obviously, we've seen it become way more topical. It was obviously very topical even in this election, and a big factor that I think swung a lot of people over was the fact that U.S. for the first time in many years has experienced a high degree of inflation. But anyway, what this shows is the debt to GDP, and it's been on a growing upward trajectory. Especially over the last 25 years. The big bump up there was obviously the 2008-9 crisis, when again governments put a lot of fiscal spend in. So the debt is pretty much what's on the books. This is literally what's on the books. 36 trillion. It's a big number. Every country pretty much around the world has got debt. South Africa's got a ton of debt. Its percentage of debt to GDP is not as high as 120%. But then we've got other economies which are way higher, China and Japan, as an example, debt to GDP. So it's a problem. There's no question. And it was a problem. It was an issue that was maybe not necessarily debated, but brought up perhaps a lot in the U.S. election. And this is partly where we've seen this the Trump and his team, and he's obviously started putting people around him, and in terms of the cabinet that he's hoping to really put together. These are the two that he's put into this new administration. Musk has obviously been hugely instrumental in backing Trump, and you can't discredit it as a dumb idea. At the end of the day, what they're saying is, well, there's a lot of problematic expenditure in government, and so you've got to try and right-size things. It's a huge task where you're looking at so much embedded bureaucracy in. But if anyone can do it and has maybe some ability to do it, you've got to back Elon Musk, and obviously he's going to be joined there with by Vivek Ramaswamy, who's a brilliant businessman, achieved a phenomenal amount in such a short space of his lifespan. I think he's only 40. I think he's 39, 40 years old. Incredible businessman as well. And so it'll be interesting to see what actually happens 4 years down the line. I mean, if they can achieve anything, it'll be great. So I've just got one slide on the US. Sorry, on South Africa. It's been a good run. We've showed this. We know the detail. I think clients in general are a lot happier with these sort of numbers: 18%, 20% returns over the last 12 months. This is a long-term slide just of the dividend yield. It's gone from more expensive levels to cheaper levels. We can see this last little piece there where the dividend yield has come back down. That's obviously where prices have run up, maybe a little ahead of some of the fundamentals. But in general, I would say it's not like super giveaway prices, but it's not expensive. It's been left alone for such a long period of time. And when you look at the foreign investors buying and selling, they've been selling for such a long period of time, and still haven't yet in any meaningful way come back. I think the tide will start turning, and in fact, it's a positive thing if we have a degree of risk on, and foreign investors need to start looking around and saying, okay, well, maybe things are a little bit expensive here. Let's go and start looking around. If South Africa can, and in so many ways, start putting some singles on the board, which they have been doing, then this positive momentum can continue. And you'll find, and we've said this in the past, it doesn't take much for foreigners to move some of these markets or some of these prices on the JSE. So I think the momentum should continue. It's a nice long-term chart there. as we've seen in the past, yeah, 25 years. I know it's a long period of time. There were definitely some positive factors which helped the JSE produce that 9.5% in dollar terms. A big one was obviously the commodity cycle. So far, we haven't really seen that yet. So we need to see China properly demanding more commodities. It's a big factor, but I think there's a lot of other factors that can keep this momentum going for a bit of time. So just one slide on South Africa. Yeah, I mean, there's so many positives. There's a lot of negatives. I think globally, you know, the tax cuts and fiscal stimulus, I think, is all positive. There's some concerns as to the inflation, and that's why I put that question mark there. The Fed easing. We've seen what's happened now since the rate cut in mid-September. Long-term interest rates have actually gone up, which is basically the market's basically saying, guys, we on inflation's actually not yet sorted out. That's why the Fed easing now is like, hey, were they a little bit too quick? The economy's actually been so strong, inflation is still sitting there, so there's that concern. Um, on the bear case, I think the biggest one is the valuations. They definitely are on the expensive side. Um, Yeah, it's not always so simple. It's not like the returns, the earnings have been coming through today. We see the results coming through for the big stock in Nvidia, and the forecast is so positive still. So it's not like the numbers haven't not been there. Obviously, a big bear case, which is constant, and we've obviously seen the escalation of that. Haven't put it up here, which is obviously the geopolitical side of things again. We've seen an escalation in the Ukraine Russia war with NATO and US getting involved. So we trust that's not going to escalate. But yeah, so there's always positives, there's always negatives. I think the main thrust of what we wanted to say today and is really again, and you just cannot underestimate that we have to be taking a degree of risk. You obviously want to try and finesse it as much as we can, and we've got to try and look through the long term. So I'm going to leave it there and hand over back to AD. Thanks, man.
Thank you, Ian. Guys, any questions for Ian at this point in time as we start talking about long-term investments? So this is a quote from Warren Buffett, and he said the most important quality for an investor is the temperamental quality, not the intellectual quality. So that's keeping those emotions in check when things do go south, which they do periodically, is to keep ourselves and our clients in check, to stay the course, stick with the investment strategy. But more on that a little bit later. So we really want to talk to you guys a little bit about financial freedom, what it means for yourself and for your clients. And on that, we want to start by a little poll, because I do believe the first step to creating financial freedom is to have a budget, and to have a budget that is green at the bottom. And as Graham said earlier, to then actually stick to this budget. That is, should be a poll popping up. Unfortunately, I can't see it my side, so Karen, just guide me on that. Um, and that you guys can please answer for us. Do you have a budget, yes or no?
The responses are coming in 80, and the
Thank you,
majority
Karen.
is yes.
Well done, guys. We can't teach well if we don't do well ourselves. So if we're telling our clients they need to run a budget, to run a surplus, to invest, we need to do the same. So well done to all of you who do have budgets. Karen, can we move on to the next one?
Sure.
And then the second thing is, if that budget does have a green line at the bottom, do you have a standing monthly investment debit order that goes towards creating your long-term wealth and your own financial freedom? And the question is always, if we as financial advisors can't create our own wealth, how are we going to guide our clients to create wealth for themselves? How are we doing on the poll there, Karen?
The responses have come in. Majority is yes.
Well done, guys.
We're looking at the percentage of yeses are 69% and the no's are 30%.
That's still a scary high number of no's, gentlemen and ladies, on the screen that we need to rectify. Hopefully, after today, you might be inspired to go and put that monthly debit order in place. Thank you all for voting. So I've asked this question of the Academy guys. I did a session with them last week, Wednesday, and I asked them, when is the best time to invest? So who can tell me when is the best time to invest? Not the Academy guys. They're not allowed to answer.
Yesterday.
Amen. The best time to invest was yesterday. The second best time to invest is today. So Warren Buffett started at the age of 10, and he regrets not starting sooner. The reason he regrets not starting sooner is because of compounding. Albert Einstein called it the greatest mathematical discovery of all time, or the eighth wonder of the world, the power of compounding over time. And we spoke about this before, but for anything that we want in life, we got to plant seeds. We got to give those seeds time to grow, and then we can reap a harvest. If you want to eat apples in the future, you got to plant apple seeds and allow that seed to grow. You can't plant mango seeds and want to eat apples in the future. And that's true for everything in our world. It's true for our spiritual life, our family life, our professional life, our relational life, our physical well-being. If you want a six-pack, you can't sit on a couch and eat slap chips and watch sport all day. You actually got to get out and do something physical. And of course, it's true for our financial well-being. So if we want to have a good financial harvest, we need to structure our seed and our time and our time frames for such a harvest. And maybe a good illustration of this power of compounding is if we look at this particular example, a Mr. Blue and a Mr. Orange. So Mr. Blue started at the age of 25, and we've included a lot of these practical slides in the session, and of course you're welcome to use these when you sit with your clients. We do think it could add some value in getting your clients over the line to understand the importance of saving. So let's look at Mr. Blue. He saved for 10 years. From the age of 25 to 30, he saved 500 Rand a month, every month for 10 years, and then he stopped completely. At retirement age of 65, his investment of 60,000 over that period has grown to 2 million. Mr. Orange waits 10 years longer. So he said, listen, I'm working at 25 to 35, but I want to buy a new car, I want to go on holiday, so I'm only going to start saving a bit later in life. So at the age of 35, he also invests 500 Rand a month. He does it for 30 years as opposed to Mr. Blue's 10 years. And and he continues all the way through to retirement with his 500 Rand a month. He ends up with 1.1 million. So Mr. Blue has almost double the amount of money that Mr. Orange has from just saving 10 years versus Mr. Orange 30 years. But the fact is Mr. Blue started 10 years earlier. And for me, this is just a great example of how compounding actually work in real terms, and an encouragement to us, our kids, and our clients to not wait another month, but to actually start investing yesterday, as we said. Another one that you might have seen before, if we travel back in time to 2001 and you had about $400 burning a hole in your pocket, you could have at that point buy an iPod, which would have cost you $399. Or believe it or not, you could have bought 1,425 Apple shares with your $400. Fast forward to 2020, your vintage iPod is now worth a little bit less than half of what you paid for it. However, your Apple shares at that point was worth $174,000. And of course, fast forward to today, those Apple shares are now worth $327,000. So how you chose to spend that $400 24 years ago could have had a substantial impact on your wealth today. And that's going to be true for the next 25-year cycles. The decisions we choose to make today might have a very, very big impact on our wealth 10, 20, and 30 years down the line. Let's bring a good investment decision back to a very practical, everyday decision. So, if you drive a car, all of us need cars to go see our clients. Your car's still perfectly fine, but it's 5 years old, and we all get that itch where we start looking at Auto Trader and We Buy Cars and all the rest of it, and you're thinking of buying a new car. Now, let's say that new car will cost you an additional 250,000 after you've traded in your current vehicle. Um, and then the question I want to pose to you is to say, what if you don't buy that new car, but you rather take the 250,000 and you invest it for the next 5 years? So you still take the loan, you still pay it off over 5 years, but you drive your old car and you invest the 250,000. In 5 years' time, you're now going to still have your old car that you can trade in. If your investment grew at 10% net of fees, which is very possible, you will have 412,000 Rand after 5 years. If you leave that alone to then grow, you can see what happens to that amount over 10, 20, 30, and 40 years for the younger people in the session. So that small decision today can have a material impact on your wealth in 20 and 30 years' time. And if you keep making those small decisions on a continuous basis, correct decisions, it can have a substantial impact. Back to our friend Morgan Housel that Ian spoke about, he says wealth is nice cars not purchased, diamonds not bought, watches not worn, and clothes forgone, and the first class upgrade declined. So wealth is financial assets that we haven't yet converted into stuff. So what is financial freedom? I mean, we talk about financial freedom all the time. It's one of our core values as a group. We want to create financial freedom for our clients. But practically, what does that mean? Who wants to venture a guess? What is financial freedom?
Work optional lifestyle.
Thank you, PJ. Absolutely. You know, I think in a very, very simplistic form, you achieve financial freedom when your passive income equals your expensive. So for most of us, if you think about retirement, what is it that we're working towards at the age of 65? We're working to create a pot of income that's going to be of such a magnitude that when we retire at age 65, that pot of income can cover our expenses until the day we die. The passive income, we stop working from that. So it's essentially assets that work for you while you sleep. And it can be things like rental income, dividend income. For us as financial advisors, it can be annuity income from your short-term investment, medical aid book. It can be capital harvesting at a sustainable rate into retirement. So for me, that's probably the most simplistic example. And of course, if you reach this point where your passive income equals your expenses, and you're still generating income by being active in the economy, you then start creating true wealth beyond this point. And then we got to say, how do you achieve financial freedom? It's good and well to know what it is, but how do we get there? How do our clients get there? And again, it's not rocket science. It's actually quite simple. By saving and investing as much as you can, as early as you can, and as often as you can. And then one additional caveat, you also got to invest well. You can't save and invest by putting the money in the bank. Well, you can, but I'll show you just now that you're actually going to go backwards in real terms. So you need to invest for growth. As Ian said, money will always return back to its intrinsic value, cash, which is zero. So we need to invest in growth assets. Here's an interesting stat. If you invest from the age of 20, 50% of your income. So you're a student, you earn zero income, you start your first job, you now earn 20,000 a month. Instead of doing your budget on 20,000, you do your budget on 10,000 and you save the other 10. If you do that, mathematically, you should be able to retire by the age of 45. And so if you save at 10%, savings rate at 10%, and you invest it well, roughly for every 9 years of work, you're creating 1 year of living expenses. If you're saving 25% for every 1 year of work, you create 3 years of work, you create 1 year of living expenses. If you're saving 50% for every 1 year of work, you create 1 year of living expenses. So the higher you save, the earlier you can retire. Very, very simple. And this diagram is probably as simple as it gets. So you earn an income on the left, you spend some of it, you save some of it, and you invest that little bit that you save well, and then over time, that little by little becomes a lot. So reaches the current income, wealth is income not spent. Wealth is hard because it requires self-control. To not buy that new car today, but rather drive your old car for another 5 years is hard because we want to drive the new car. But by making a good financial decision, you change your wealth outcome over time drastically. If you do read that book of Morgan Housel, you'll learn some very valuable lessons. He also said to himself, what if I wrote a letter to my child that I would have liked to receive from my dad when I was young? What would be the lessons I put in there? And he put these 9 life lessons into this letter, and I briefly want to take you through it. And the first one he says is don't underestimate the role of chance in life. Some of these are finance related, some of it's more philosophical, life related, but I think all valuable. And he's saying it's easy to assume that wealth and poverty are caused by the choices we make, but it's even easier to underestimate the role of chance in life. So things like families, values, countries we live in, the generations we're born into, as well as the people we happen to meet along the way and surround ourselves with, all play a bigger role in our outcomes than most people want to admit. So while you should believe in the values and rewards of hard work, it's also important to understand that not all success is the result of hard work and that not all poverty is due to laziness. And keep this in mind when forming opinions about others, including ourselves. The second point he raised in his letter is the highest dividend money pays is time. So being able to do what you want, when you want, where you want, with who you want, and for as long as you want, provides you with something that no amount of fancy stuff can ever offer. So the thrill of having fancy stuff wears off quickly, but a job with flexible hours and a short commute will never get old. Having enough savings to give you time and options during an emergency will never get old. Being able to retire when you want will never get old. That's the financial freedom we just spoke about. So the highest dividend money pays is that actually gives you time. The third one he says is don't count on getting spoiled. So learning that you can't have everything you want is the only way to understand needs versus desires. And maybe an important point with Black Friday looming around the corner. So if you've got that flat screen TV already saved there in the shopping cart, the online shopping cart, maybe go and delete it. So this in turn will teach you about budgeting, saving, and valuing what you already have. Driving that old car. Knowing how to be frugal without it hurting you is an essential life skill that will come in handy during life's inevitable ups and downs. I think we can all agree that's true. And then probably the biggest one of the 9 is that success doesn't always come from big actions. So Napoleon had a very interesting definition of a genius. He said a genius is a person who can do the average thing when everyone else around him is losing his mind, thinking of a soldier in battle. Managing money is the same. So you don't have to do amazing things to end up in a good place over time. You just have to consistently not screw up for long periods of time. And that's true for us and our clients. And that screw up can be selling at the bottom of a bear market. Um, Avoid catastrophic mistakes. And I think the biggest one we make and our clients make is to bury ourselves in debt. Remember, saving at least 10, preferably 20% or more of your income consistently, following a good investment strategy, that's key to financial dependence. It's that little steps on a consistent basis. It's not calling the next upswing and going all in and calling the next downswing and going all out. It's doing the small things consistently right. The fifth point he raises, live below your means. So the ability to live with less is one of the most powerful financial levers. because you have more control over your budget, what you spend, than you have over your income. You don't necessarily have, as financial advisors, we do, but we've got more control over what we spend than what we're going to earn, or on the returns we're actually going to get on our savings. So a person who makes 200,000 a year, for example, but only needs 160,000 to be happy and to live comfortably, is actually richer than a person who earns 500,000 a year, but needs 600,000 to be happy. Of course, the investor who also earns for 5% return, but has low expenses, may be better off than an investor who earns 10% a year, but needs every penny of it. So it's not about how much you have. It's about what you do, what's in your hands that matters. It's okay to change your mind. I know very few people who've got their life figured out by 18, and I think most of my interesting friends still don't quite have it all figured out at the age of 50. So it's not the end of the world if you change your mind. And forgiving yourself by changing your mind is a superpower, especially when you're young. Don't forget that. The seventh thing he said is everything has a price. So the price of a busy career is time away from your friends and family. And the price of long-term market returns is uncertainty and volatility in the short term. And that's such a key thing for life and investments. And once you accept it, you'll start to view things like time, relationships, autonomy, and creativity as currencies that are just, if not more valuable than cash. He also says money is not the greatest measure of success. So those of you who know me might know I do enjoy a bit of classical music. And Ben Zander, who's a conductor of the Boston Philharmonic Orchestra, he's got applications 5, 10 deep for each of the positions in his orchestra at a time when most other symphonic orchestras around the world are actually struggling to survive and struggling to find musicians to play. And then you ask yourself, why is Ben Zander's orchestra so efficient and so successful? And then when you start understanding him a bit better, and then you start to understand why. So Ben Zander's definition of leadership and success is probably the best definitions of leadership and success I've ever heard. His definition of leadership is, what am I doing to be the light in your eyes? And then on the back of that, his definition of success is, how many shining lights do you have around you? And for me, that is probably a much more powerful measure of success, the number of shining lights you have around you, than the status of your investment account or your bank account. And then lastly, he says, don't blindly accept any advice you are given. Listen to what's out there, contextualize it, understand it, but do your own work, overlay the advice you get with your own reality check. So nine lessons. I hope there's some value in there for some of you. Moving on just to savings and investors. Who should be investing? Of course, all of us. We need a budget first that generates a surplus. We need to invest to have an emergency fund for education, for a deposit, for a car, for a house, maybe that overseas holiday. All of us need to save for retirement. And when we start planning our investment journey, the most important ingredient, and this is not a new slide to any of you on the screen today, is investment strategy. Understanding that if you or your clients got R1 million to invest, what portion of that R1 million are you going to need in the next 3 years? Meaning you need an income from that, you need liquidity from that. That's if you're drawing a monthly income, emergency funding, a car you need to buy in the next 3 years. That sits in this pot here. We invest cash, fixed income funds. Nothing more risky than that, and we're targeting inflation +1. Ian spoke about it. Our biggest enemy as investors is inflation. And for our clients, we've got to make sure that we put them in solutions that's going to help them beat inflation over time. You look at that same million, whatever that million you or your client's going to need in the next 4 to 7 years, that goes into this middle pot. There's a bit of income you might need out of that. You also want capital growth. We're targeting inflation +2 through to inflation +5. So we're doing a bit of wealth generation and growth whilst bringing in risk assets. And then on the far right-hand side, That portion of the R1 million that your client or you is not going to need for the next 7 years, that should sit in pure equities or flexible funds on the far right-hand side. It doesn't matter whether your client is a conservative investor or an aggressive investor. You should take the time to educate him, to educate yourself, to apply this strategy. Then you're delivering real value to your clients. You're giving him good financial advice and you're helping him to implement a strategy that doesn't matter what happens to the markets, he can stick to the strategy. If the markets goes down tomorrow by 20%, he doesn't need to touch his equity portion because he doesn't need it for the next 7 years. He's got 3 years of income liquidity buffer on the left, so he can ride through the bear markets and wait for the markets to recover. So we've spoken about this a lot in the past, but I think it's something that we just always got to remember to come back to. And if we do this right up front, we really make our lives as advisors and our clients' investment journey so much easier. Of course, there's always this trade-off between risk and return. You can sit in cash and you've been earning a reasonable yield for the last period in cash when interest rates was high. But after tax and after inflation, most often you're in the red. And I'll show you a table on that just now. You can then, of course, go up the risk curve into income funds, bonds, property. Long term, and I'll show you a slide on that now, equity is still your best asset class if you're going to be investing for the long term. Of course, sometimes we are our own worst enemies. Think about the media hype. Think about how markets go up and down. When markets do correct, the media will tell us it's time to panic, it's time to sell, the world's coming to an end. But anybody who follows a proper strategy and understand that I'm invested in a good fund, who invest in good businesses, when markets pull back, that's actually an opportunity to buy good shares at discounted prices. And if we've got dry powder and cash sitting on the sideline, a fantastic opportunity to get into the market. So we got to help ourselves and our clients not to be this dad on the left, but to stay the course, stick to our strategy, and be wise in how we go about doing it. And this graph is the proof in the pudding. So you can see the, call it bluish greenish line that goes straight up here. That's our cash line. Over a period of 24 years, we're looking at, you'll see this theme of 25 years coming through in all the slides. We've invested 100,000 Rand in the bank. We left it in the bank for 24 years, and that cash pile has grown by 385%. However, somebody who's invested that same 100,000 in equities because it's 25-year horizon, it's longer than 7, his investment has grown by 1,361%. So, Mr. Client, Mr. Conservative Client, do you want to sit in cash and leave all of this money on the table over time? The price you got to pay for this higher return is the volatility. You got to understand that markets go down from time to time, but because you've got a long-term horizon, it doesn't matter. We stick that portion of the strategy, we keep it invested in equities for the long run, and we are going to give you the best return we can by doing that over the 25-year period. As opposed to the client who sat in cash, was maybe at a 40% tax rate. Those are the actual inflation numbers since 2012, and you can see the real return that your client got. There was 1 year, 2019, where it was 0. All the other years, your clients have actually gone on average backwards by 2% a year in real terms. So their purchasing power has diminished by 2% a year. And clearly that's not a good investment strategy or plan for anybody. So when you invest your client and you implement that investment strategy, important for your client to understand what they can expect over any one calendar year. Setting in equities, you're going to have years where it's maybe minus 25%. You're also going to have years where it's maybe plus 47%. On average, you should get around 14-15% from your equity portfolio. And so you can show him each asset class. I copy this into all my record of advisors, to all my clients, so that they understand the journey they're about to embark on, and it makes their lives and our lives so much easier. A question you guys probably get asked a lot, I certainly do. This is a quote from old Barry Hugo, one of our advisors as part of our business. And he said it's probably the question that he gets asked the most by clients and people that he meets socially. He says, unfortunately, answer is not a simple one, and it depends on 4 basic variables. That's Barry, for those of you who don't know what he looks like. I don't know if you're on the screen, Barry, I can't see. So he says the first thing is income needs. So obviously, the more income you need, the larger capital amount you need to draw that high income off. The second thing is your retirement age. The earlier you retire, the longer you're going to be drawing down. It's the bigger capital amount you need. Your life expectancy for both partners need to be considered. So ladies already have a longer life expectancy than men, and often wives are younger than their husbands. And you guys will also remember the stat that married men on average live a lot longer than single guys, but they're a lot more willing to die. Not pertaining to this, but another fact of life. I'm just joking. And then, of course, lastly, investment return. So the lower the investment return, the higher amount of capital you need, and vice versa. So what does it mean in a scenario analysis? So if you and your wife are the same age, you target an investment that will give you an inflation plus 5 return over time, you need 25 times your annual combined income as capital. So if you earn roughly R1 million between the two of you and you want to retire at age 55, you need 25 million rand to retire. If you're going to work a little bit later to 60 or 65, that multiple starts coming down, and even more so when you go past 65. This was an interesting table. It's inflation adjusted, again, the 25 years, and it talks to how much money do you need to save on a monthly basis, given a certain rate of return, to get to $1 million. Now, not so long ago, if you had R1 million invested, you were a wealthy person. Unfortunately, R1 million in today's term is not a lot of money. We as South Africans need to think of our wealth in global terms and dollars. So a few lessons from this. The more you invest on a monthly basis, the quicker you accumulate wealth. The more aggressive you invest, the quicker you accumulate wealth, and vice versa. So for us South Africans, to get to $2 to $1 million over 25 years, we need to invest around 27,000 a month with a 9% annual return net of fees. That will get us to $1 million in 25 years' time. Another way, little max box calculation for your client to say, I want to draw 125,000 when I retire. What amount of capital do I need? Of course, depending on your drawdown rate, 5% is very sustainable, and you can probably continue to grow your client's wealth. 7.5% is probably at the high end of what your client can draw down, and at that level, they'll probably will deplete some of their wealth over time. The reality is most people draw somewhere in the middle. I think the average number that I saw was 6.6%. And you can see to draw 125,000 a month, you need about 20 million, a capital amount, to get there. Don't forget the power of compounding. In 30 linear steps, we can walk across the road. In 30 exponential steps, we can walk around the earth 26 times. And you can go and do the math. It's true. So start saving as soon as you can and get your clients to start investing as soon as they can. The last example on this is just, and it shows it in a very extreme way, is 1,000 Rand invested in the JSE in 1970 versus 1,000 Rand invested 20 years later. The first 1,000 Rand has now grown to 432,000, and the 1,000 Rand that was invested 28 years later has grown to 28,000. So Warren Buffett started at the age of 10. He had a wealth of $9.3 million by the age of 30. He didn't kick up his feet and retire. He kept on working and invest. By the time he retired at age 65, he had a decent wealth. I think it was about $3.5 billion. But you know that he created 86% of his wealth after his retirement age of 65. Again, just a very powerful example of compounding over time. Here's a current reality for South Africa, and hopefully not for most of us on the screen. only 6% of people are able to retire financially independent, and that 6% is calculated on a 75% replacement ratio. It's not even on 100%. For the rest of us, for the rest of our clients, forced to work longer, depend on a state pension, or depend on family. So our job as financial advisors is to firstly make sure we're part of the 6%, but to also work hard to get our clients to help them get to be part of the 6%. And for most of it, it means that they need to invest in risky assets to get the inflation plus 5 returns over time. And if you want to really scare your clients, show them this, the amount of paychecks that they have till retirement at age 60. Guys, that's it from us. We got a few minutes left. We really want to encourage you and your clients to really start your financial journey to freedom today. Any questions from anybody? If there's no question, guys, we hope the session was valuable. As always, the slides will go out to all of you. You're welcome to use it, some of it, when you sit with clients. We will see you on the 19th of February 2025 for our first session of next year. For those of you guys we won't see before the end of the year, Merry Christmas. Have a wonderful, safe holiday times. Enjoy the time with your family and time off to relax and recover and recoup for next year. And thank you for all the support this year from the C team. We really appreciate your partnership with us. And we look forward to what we're going to do together in the new year.